Welcome to all. This presentation is for business analytics and intelligence model. My analysis focus on the UK electricity production industry using farm source data from 10 leading companies over the period of 2014 to 2023. The study is uses a 10-year panel data set extract from the FAME focusing on the UK electricity production industry under SIC code D35 110. The dataset including the detailed financial and operational information from 10 leading companies between 2014 and 2023. For this version of the project, I will selected 5 key metrics that are related to capital intensity and financial health, total assets liquidity ratio, number of employees, wages and salaries, and profit margin. The central research question is whether companies that expand their asset base are also maintaining operational and financial balance, or if growth comes at the cost of liquidity or workforce efficiency. Mm, This slide presents the decade-long revenue trend for the UK electricity transmission and distribution industry, sourced from the Statistica ASEA. As of 2021, the industry generated 10.3 billion USD, according for 15% of European market revenue. Its project to growth strategically at a 5.1 percentage, reaching 15.75 billion by 2013. This indicates a healthy and expanding industry driven by ongoing infrastructure upgrade, smart grid technologies, and this decarbonization target in line with the UK's net zero ambitions. Understanding this macro level contents is crucial for benchmarking company level performance in later in our analysis. This visual compares the number of employees across 10 leading electricity companies in the UK for the year 2023. Centrica PLC with over 20,000 employees tops the list, highlighting its expansion service network. Companies like Uniper and Drax Power have a smaller teams, possible due to higher automation or more focused operation. Employee count provide a basic glance into your organization size. But we will further explore how it's aligned with the financial performance and operational efficiency in the upcoming slide. This chart shows the liquidity ratio of UK electricity firms in 2023. Liquidity ratio measure a company ability to meet a short-term obligations. Companies like SSE and EDF Nuclear exhibit strong liquidity, signaling robust cash reservoir, working capital management. Conversely, firms with a lower ratio may face together cash position, potentially affecting their resilience to sudden operational shock. While all companies function within the same regulatory landscape, this financial disappointing highlighting these differing capital strategies and risk updates. This area chart maps the evaluation of total assets across 10 major electricity firms in the UK from 2014 to 2023. SSE and EDF Nuclear constantly maintained large asset base, reflecting heavy infrastructure investment. British Gas and Drax show a steady upward trend, indicating operational expansion or acquisition. In the contrast, companies like Uniper and Eon exhibit relatively stable asset level, potentially indicating conversation growth strategies. These companies highlighting which frame have grown fastest and which have maintained asset consistency across the decade. The differential statistics across five key merits for the 10 UK electricity firm in the 2023. The mean profit margin 3.4 percentage, but sharp negative minimum of minus 77.9 percentage and a positive maximum of 47.9 indicates high volatility and a potential loss, making firms the standard deviations for employees and assets reflected the uneven scale of the operation from lean operation to major corporation liquidity ratios span from 0.17 to over 6 with a mean of 1.2 showing the significant variation in short term. Financial stability, additional wages, data on employee number of together, rival insufficiency, and payroll to size mismatches. The high Cretaceous value, especially for the liquidity and the profit margin, suggest the presence of extreme values are outlier, which uh, which could heavily influence mean by based on analysis. This insight from inform us where to dive deeper in recognition or correlations. This correlation matrix gives us a snapshot of how closely our merits moves together as expected wages and salaries. And the number of employees have a very high positive correlation, which tells us payroll cost to scale tightly with the workforce size. And another notable observation is the moderated link between total asset and both workforce and wages, indicating asset rich frames tend to the employee more people and pay more. However, the liquidity ratio seems quite disconnected from the rest, showing a weak or even negative correlations, suggesting the biggest asset heavily or paying high wages does not necessarily mean better liquidity profit margin. The shares of a moderated bond with liquidity and total asset, hinting that stronger financial backing may help support profitability, but not always directly. This regression analysis investigated what the drives profit margin in the UK electricity sector. The model explained the around 25.6 percentage of variations, which is the moderator for the real world data in the finance. We find that the liquidity ratio and total asset are significant production predicted. So this means firms with the stronger liquidity and larger asset based trend to report higher profitability. This support financially theory starting the solvency and scale influencing operational margin. Uh, Weston and Brigham in 1979, the indicating number of employees is not a significant factor. P is equal to 0.14. This suggests a workforce size alone does not guarantee higher margin profitable due to operational insufficiency or automation in larger firms. The F test also show the model as a whole statistically significant F equal to 11.05 and P equal to 2.7 e power minus 6, meaning its unlikely relationship is due to changes. This scatter plot exposes the relationship between liquidity ratio and the profit margin across a 10 UK electricity from the positive slope of the trend line. Confirm that the firm's liquidity improves, their profitability trends increase. The while correlation is not very strong. R square equal to 0.1327. The regression result there statistically significant of this variable p equal to 0.0038. This indicates that the heavy enough short-term asset to cover liabilities meaningfully to a better margin. However, the presence of extremely outlying likely reporting to anonymous or stacking needs influencing investigations. The statistically evidence from our organization show the while liquidity ratio total asset having a significant influence on profit margin, practical impact is relatively small, is just r squared of 0.23 tells us only 23 percentage of a variation profit margin is explained by the chosen predictors, highlighting the complexity of profitability drivers in this sector. Additionally, the correlation matrix revealed very strongly links between the wages and salaries and employee count are is logically scaling of equal to 0.7 had in bearing profitability from the scatter plot. It's evident that the larger firms with high asset are not necessarily too profitable, referencing that the needs operational efficiency over size. Overall, this industry demonstrated higher genesis performance with notable outlines under room strategic optimization. Based on our finding, the UK's electricity transmission and distribution sector should shift focus on the simply scaling asset or increasing workforce to improve asset productivity and liquidity ratio. Moreover, the dispensary statistic revealed a high standard deviations, especially on profit margin, not for all firms operated by optional efficiency. This accumulation then the profitability with over depends on the assets. Thank you.